Thank you, Plutarchos, for inviting me in the company of what you used to call as students big heads. The financial crisis heralded the end of 40 years of traditional banking, mainly US banks becoming the dominant international players from London, New York, and continue even now to expand. Few European banks succeeded to become international and to overcome relatively unscathed the financial crisis. Others, surprising even UK banks with a long history, were bailed out, as well as lender and commercial banks, pillars of Germany regeneration. Even now, many European banks, especially in countries with a weak recovery, are undercapitalized, and some of them have to go under. The first question: should there be a recession, will these banks trigger a financial crisis? Related to that, is the global economy in danger of experiencing a major disruption that may cause a financial crisis? Economic fundamentals suggest that the United States will grow at about 2%, and the laggard European Union growth is accelerating, with more countries, especially France is very important, partaking. China shows robust growth, though much smaller as it moves to the middle-income countries group and has lost its productivity leaps when labor moved out from subsistence farming. In the developed world and in many emerging markets, inflation and fiscal deficits and debts are within reasonable grounds. Even if on economic grounds there is no reason to worry, geopolitical risks are on the rise and would affect the financial sector. Trump's Brexit, aggressiveness in the Far East and closer in Eastern Europe, the Middle East conflicts, ISIS, but also the unwavering stream of impoverished migrants, mainly from overpopulated Africa, increase uncertainty, dampen growth, and disturb financial flows. And also because of these factors, but more importantly because European Union lagged behind the new industrial IT revolution, half of European Union population sees its income, if it sees its income continuing to fall, or since the 90s, populism would flourish. Has populism reached the necessary mass to destabilize democracies? This is a very important question mark. If we see what happens in the next elections, then we're going to see a link of events. Immediately there will be looser fiscal policy, delays in structural reforms, business investment projects already are postponed and will be further stopped, and the subsequent unleashing of speculative reforms will definitively spill over to the financial sector. Hopefully, the next round of US and European Union elections will disprove the bad scenario, and the economy and the financial sector will not be significantly affected by what history would describe as a transient episode. The second question: is the world financial system solid enough to withstand a shock without much damage? The new stringent capital requirements and bank profits building up capital buffers are important safeguards. Tier 1 capital is about 12%, much higher than before the crisis. Banks' leverage is increasing to more than 3%, and there is ample bank liquidity. However, on their own, they don't provide an all-round protection, because we saw how fast liquidity and capital can be depleted in a crisis. More important guarantees are the new governance, compliance, and risk rule, and this SSM supervision on its 76, 78 banks, I can't remember, and 126 if we also include ECB supervision. The single supervisory mechanism will be reinforced later by the single resolution mechanism and insurance mechanism. But really, to be honest, if these have to really function, all banks have to be on a level playing field, because you don't start a mechanism where you know that next day some of them will go under and you will have to pay. So I understand fully the German position. A new management, transparent culture is setting in, and the independent audit divisions, which have been upgraded within the banking hierarchy, improve the lines of defenses against crisis. ECB, SSM, EBA rules have not spared the screening of the top managers, which are increasingly accountable. The rule of law has reached the banking sector. Rot starts from the head, and the imprisonment of some senior financiers and big fines has helped to change culture. But also in some countries, not only Southern European countries, you spoke about France and Napoleon, state intervention to help ailing projects were also responsible for the demise of a few banks. Bank loans cannot be a substitute to government grants and subsidies. The risk strategy and management occupies now a central position in banking. Risks are assessed, quantified, and mitigation plan exists to prevent irreversible events. However, many of the new rules and restrictions overburden the banks, increasing their operating costs and diminish profitability, making banks less attractive to shareholders, hence making difficult to reach a high capital adequacy target, which is envisioned by supervisors. The balance between flexibility and yield vis-à-vis overregulation has tilted in favor of overregulation. From some 5 or key risk areas, now banks will define more than 10 key risk areas, including subdivisions about 30 to 35. And banks have to elaborate risk strategies and, more importantly, risk models attaching to each of these 30 risks a relative weight. I think there is going to be a haze when discussions come between supervisors and the banks themselves about what will be the weight of each of these risks, which are more than 30. Demands by regulators and supervisors should stop increasing because there are many supervisors. You are SSM, you have the local supervisors, the national bank, and then you have certain rules. And there is too much demand by these various institutions with overlapping competences. If banks are not to be overweight, affecting their business performance, and a mid-road can be reached without sacrificing the essentials, which is transparency, internal compliance, audit, and risk management. In addition to the above, the repealing of Dodd-Frank and the relaxing other US regulations, which are coming soon, will further reduce the international competitiveness of European banks. And they have to reorient the business models, all the more that banks, European banks, are also threatened by fintechs, and the light regulation and loose supervision of equity funds, hedge funds, asset management funds, direct lending, etc. Their market share is increasing, and it would be wrong to assume that these institutions cannot kick off a financial crisis that would also engulf many banks. The banking sector occupies the dominant position in the European financial scene. It is the essential link in the financial chain, and the tremors from whichever part of the chain start, the ripple effect will be reach the banks. In the face of strong US competitors in investment banking, if European banks are not given more leeway to determine the operating model according to their business objectives, according to the region in which they operate, they will lose market share globally and a big source of income. Many Chinese banks are undercapitalized, but with the state filling their capital and liquidity gaps, they make also their presence felt internationally, especially since Chinese foreign investment in developed countries is growing fast with the support of these state funds. European banks have to remain global. Players and all stakeholders have to concur instead of seeing them turning inwards. Finally, digitalization of the banking sector is moving fast. Customers have new products, and as bank transactions are being automated, There will be significantly fewer employees at the front line, tellers at branch level, and much less paperwork. However, this will be largely offset by more people in the middle and back offices, and also because of the new upgraded control functions. In addition, many employees will work in the IT departments, especially to counter hackers who can damage essential bank functions, leading to big losses. The more digitalization increases with centralized IT systems for cost saving and speed reasons, the greater will be the risk of cyber attacks necessitating stronger protective walls. And the remuneration of the IT staff as well as the cost of the IT system is high, so the cost saving from digitalization will be relatively small from traditional European banks. A postmodern banking model is emerging, with IT supplanting human contact, which was so reassuring to clients in the past. About 15 to 18% of bank staff is in the IT sector, and more, and if we include a lot of outsourcing, there will also be about 12%. The only state parameter in economic is change. I'm not a pithy in Delphi giving ambiguous answers, but really we must not write off that in a few decades banks and their functions will become again more decentralized to guard against cyber attacks, which with a centralized system can paralyze all the banking functions at once.
Thank you very much, Mr. Thomopoulos. I think points that, I mean, among others that would be interesting to discuss later on is, first of all, you do have a positive outlook overall for the banking system, both for the European and for the Greek one, but you see some risks.
No, I have not spoken about the Greek one.
Ah, okay, so let's say the European.
Because I think Mr. Provopoulos and the previous speakers
okay.
had an extensive discussion, so I won't repeat it.
Right, so indirectly then maybe since we are part of the European banking system.